Ladies and gentlemen, good morning. Welcome to the Gas Buyers Forum. My name is Jaime Concha. I'm the Senior European Gas Reporter for Energy Intelligence. And with me to discuss new emerging markets for gas and LNG are Peter Abdo, Chief Commercial Officer, Global LNG and Origination at Uniper Global Commodities, Kevin Gallagher, Managing Director and Chief Executive Officer at Santos, Professor Keun-Wook Paik, a Senior Research Fellow at the Oxford Institute for Energy Studies, and last but not least, Tarek Souki, Senior Vice President, LNG Marketing and Trading at Tellurian. The gas and LNG market is growing both on supply and demand, as you have seen in the previous presentation. But the big question is whether we can rely on the preconceptions of where demand is coming from. So to start things off, I would like to ask the panel, is the preconception of where demand is coming from does it still stand? Is it still Europe being the traditional mature market, the big demand centers in China, Japan, Korea, and then the new niche markets coming from Southeast Asia, or has something changed recently? Kevin, would you like to?
Sure, thank you. Look, I think from our perspective, I think the first thing is that we're still pretty optimistic that there's growth, and that growth will continue over the next few decades. And so I think those traditional Asian markets particularly will continue to grow, but at a much more moderate or slower rate than maybe we've seen in recent years. So I still expect some growth from the sort of legacy markets, if you like. And we'll see more growth from those Southeast Asian markets. You described them as niche markets. And I think the latest IEA forecasts were indicating a sort of cumulative growth of around 1.6% per annum between now and 2040. And we'd expect those Southeast Asian markets to come up to a sort of an equivalence of the traditional markets by that time. But it's a slow growth. It's not a rapid growth like we've seen in recent years in China, say. That's how we see it.
Yeah, does the panel agree with that, Tarek?
So I would say if you look around the world today, you've got some of the less traditional buyers that are starting to really take hold of some significant volumes. I mean, 10 years ago, if you would have said Pakistan was going to be a 20 to 30 million ton player, nobody would have thought that, and here they are, they're on their way. And then you have places like Bangladesh, India, that's becoming a traditional buyer, but they've got a lot of growth ahead of them. And then you have other places around Southeast Asia that have just started their journey. And I think that when you take them all as a sum total, you'll have something like a Korea, like a Japan, and then some of them, like India, for instance, will surpass both Korea and Japan sometime in the next, I'd say, 15 to 20 years. So I have a lot of optimism for new growth markets.
I mean, I think that's the case. I mean, I think there's quite a bit of optimism about all these new markets. And I remember, just like 5 years ago, when I'm sure a lot of us were kind of sitting around and kind of setting expectations and what the world would look like in 2019, 2020 in these new markets. The estimates had really wide ranges. The demand is just come on a lot slower, I think, than many people would have expected. And a lot of that demand, unlike our traditional LNG buyer, a lot of that demand has been industrial, and it's a completely different type of, let's say, sector and business model than the LNG market would be used to.
And what about the more legacy established markets? Europe comes to mind, but also the ones in Asia, like Korea and Japan. I'm not sure. Would you like to comment on South Korea and Japan?
With regard to this growth potential from Asian market, everybody agrees that the driving force of this growth is coming from Asia. But the way the mainstream buyers from Asia, in particular Japan, Korea, China, their stance on this growth rate is a little bit different because Japan and Korea are they are comfortably accepting this price setting, conventional price setting. But China is beginning to mention about, are we ready to take up this price setting as before? But now they are thinking of this. Time has come for them to think of this price setting by the consumer. Now, the most important thing is that there is a huge potential of growth if this affordability of gas supply is agreed by this emerging, in particular, countries like China, India, and then Indonesia, which are depending massively on this coal power. But they cannot switch from coal to gas because of this affordability problem. So if there is a consensus and then find a way to satisfy the expectation from both supplier and then buyer, I think there is a good potential of the real growth. But I would like to highlight the difference between Japan, Korea, Taiwan. Those are the main players. They are taking the price issue, and then now Chinese, they are taking a little bit different stance from the buyer's viewpoint.
And what about Europe, for example, being an established market, the market of last resort? Is it still just smooth sailing, stable demand?
We don't call it a last resort. We call it today a balancing point. But no, Europe, let's face it, Europe has been very sleepy, right, over the past number of years in terms of LNG, and we all know why. But it has certainly woken up over the past 12 months. Regas is at very high utilization rates. Our storage is very high at the moment and has been. We expect that to continue. Why? Because Europe obviously is a very flexible market, it's a very transparent market, and it's a very liquid market. And so it's perfect for a commoditized product like LNG, and that is where we are. But in addition to that, Europe needs LNG. I mean, if you just look at the fundamentals with our indigenous supply, with the political drive to exit coal, and we all know what's happening in Germany. I mean, it's very, very well publicized what the German government plans to do with coal by 2030. So taking all that into account, Europe is a growth market for LNG. It has to be.
Which is interesting. The topic of the energy transition is quite important, and we might cover it a little bit later because I think it would influence future demand. But before we get there, now that we've done an overview of more or less how the lay of the land is there or are there any obstacles that are common among these, let's say, emerging points of demand, especially in Asia, that you can identify? I don't know, if somebody would like to take the lead on that?
Well, I think one of the obstacles, I don't really see it as an obstacle, it's just normal sort of market development, is the lack of infrastructure in some of the sort of new emerging buying nations. But that's always the case, and it just takes that little bit of time to get that sort of critical mass of infrastructure installed in any new environment. And so that initially will slow down some of the developing markets, but ultimately it'll get to that critical mass point, and then you'll see those markets being able to take off. I think that's one of the advantages the established markets have across Asia, that they have very extensive installed infrastructure, and so that is an advantage for smaller companies like ours. Mm-hmm. So when we're selling, that makes it easier for us to deal with those sort of legacy customers, legacy buyers, because we can see that sort of line of sight to the market.
I think speaking from our own experience at Uniper, I guess when we look at some of the obstacles, we generally, and maybe because we're a traditional European utility, and for 100 years, what have we been doing? We've been building demand for gas, So we've been kind of like on the other side of things, where really it's key to build that demand, whether it's in the power sector or whether it's in the industrial gas sector. And so once again, kind of like building from our own experience, we've found that to be a big obstacle for for these new markets. But we just have to continue to plug away to build that demand. And then in terms of infrastructure, we've also found that in these kind of new markets, obviously there's for the first number of years there's excess capacity that has to be paid for, and so clearly that kind of takes away from some of the economics of different projects. So there's like two obstacles that I can think of.
But in terms of Uniper, does what kind of demand side infrastructure projects are in the works, at least in these new emerging markets?
Yeah, so I mean, clearly, like the Middle East, we've completed a FEED study on a particular project. We've put together the supply strategy around that project, and once again, the kind of like when that project first came up, the first thing that we did is we mobilized our engineers. We mobilized our gas sales team and went off into the market and kind of like tried to tackle that particular topic first to create that demand. Mm-hmm. And then we backed into the infrastructure and the supply. That was our own experience.
Right. And I mean, the rest of the panel may have an opinion of this, but in terms of these demand side strategies, does size have anything to do with this in terms of the ability of your companies? I'm thinking of Tellurian and Santos, of course, of developing this demand side value in these emerging markets. So, is size a constraint in terms of developing infrastructure, for example?
Are you asking if size matters?
Yeah.
Look, I think in certain things, when a lot, let's take 2014, 2015, for example, when it looked like demand was drying up a little bit in the LNG market, certainly in the energy markets around the world, and a lot of people were rushing towards gas to power type projects, right, to spur demand. So places like South Africa, Vietnam, Philippines, none of those projects have materialized. Here we are 5 years later, they haven't even moved forward, right? So if you go on individual projects at a time, yeah, it can be very difficult. So it has to almost be like a wholesale, systemic type of program sponsored often by a government to get a new market to develop. Or maybe if it's coming from the other side and you get, sort of a major coming in to develop a market, then maybe that can balance that as well. But I think you have to have a certain critical mass. I mean, for us to go and sell 1 million tons, yeah, sure, we'd love to sell 1 million tons into a new market. But at the same time, if you're going to do less than that, it starts to become less interesting. You've got to put a lot of sub-million ton players into a new project to get a new project off the ground, right?
Right.
I think size definitely matters, but what's much more important is flexibility.
Right.
In these projects. At least the projects we've been involved in, the buyer was very confident that they could get the supply. Really, what they were asking for was flexibility. Whether it's seasonal, whether it's ramping up as the demand. I keep going back to demand, as their demand kind of like ramps up. That's really to me the key.
I think I agree completely with the points made already on size. I guess the one thing I'm seeing now is the development of new business models on the seller side, and a much more rapid pace than I would have expected only a couple of years ago. And so you're seeing all these new models starting to develop as I think we move towards a more commoditized product in the future, a more commoditized market. And for me, what that means for Australia and for companies like Santos is that we can become more of a niche seller. Our projects are all going to be brownfield projects going forward. They're smaller projects that can be equity financed. So we don't have the same constraints that we had in the past where we needed project financing or long-term large contracts to underpin those investments. And that gives us a lot more flexibility in how we can market right across the Asian region. And I see proximity to market being an advantage in in that sense as well.
With regard to this size, I would like to comment on this Chinese experience. When I started on this pipeline gas, multinational pipeline gas development in China, at that time, it was during late 1990s. They were talking about 200 BCM and 300 BCM. It was a dream figure. But now they are talking about by 2030, the figure they are talking about as much as 600 BCM. Out of 50%, that's for domestic production. And then the remaining 300 BCM virtually divided by LNG and then pipeline gas. So Chinese are thinking that, yes, this demand expansion is very important, but how can you control this price burden? So how to balance it? So when they are talking about, actually, at the end of this year, pipeline from East Siberia will come down to Hebei, where Beijing and Tianjin are located. But very recently, President Putin, a month ago in Vladivostok, he was specifically mentioning about this pipeline gas import by Altai gas, not through Xinjiang, but the possibility of a Mongolian route was for the first time mentioned. Actually, this is a very interesting reminder. 2002, NDRC, National Development Reform Commission, they have completely ruled out this transit pipeline from Mongolia. But when we studied 1997 and 98, at that time, this Mongolian route is the most ideal and then the most competitive price China can get. Now, what impact it will deliver if that is directly coming, this Altai gas is coming to Hebei through Mongolian route? It will be the most competitive price. So people are thinking of, the planners are thinking of when these suppliers are talking about what impact it will deliver. Do we have enough leverage that can balance this supplier's expectation and buyer's expectation?
I made a note about what you mentioned, Kevin, about business models, and I was wondering whether, from the U.S. perspective, you have any opinion about, what are the business models that are more optimal to develop these markets, to reach these markets?
To reach markets, I can't say, but I think somebody made a comment about a commoditizing industry, and I think when you look at something like that, the key then is to be the low-cost provider of the resource, right? And so I think the business model that you have to focus on today is not going to be one where you have a 20-year take-or-pay contract, particularly for a group that starts, that won't be able to deliver its first molecules for 5 more years, right? And so your 20-year contract starts 5 years from today. I think you have to be in a commoditizing market, you have to be the low end, the low cost provider. And I think for the US, we have a big advantage on the fact that we can build liquefaction more cheaply than anywhere else in the world. We have the labor pool, we have proximity to human capital markets, we have the proximity to financial capital markets. And so I think that's the important thing. Will it facilitate new markets to new market demand? Absolutely. I think if people are purchasing, not to toot our own horn a little bit, but if you go to a cost model like we're proposing to our investor group, you really will always be in the top quartile of producers. And if you're doing that, it opens up the possibilities in any other market that you want to help develop. So, for instance, Japan right now is starting to develop new projects in places like Thailand. When they do that, it's important that they have low-cost LNG to be able to do that. And I think these types of models are going to be the only way forward versus a 20-year take-or-pay contract.
Kevin, do you have any comments on that from the Australian experience?
Yeah, well, I guess we can't claim to be the lowest constructors and lowest cost constructors in the world in Australia. That's for sure. but we've got high-quality infrastructure installed counter to that. But no, what I would say, though, is the fact is it's been built, though, right? It's been built. And so as a lot of those legacy projects come to the end of their first round, and even in cases, projects like the Northwest Shelf, their second round of contracts, what we're seeing is new models emerging where we're looking at tolling infrastructure, tolling business models being put in place. And the brownfield projects, like our own Barossa project, are very competitive with any supply from any other part of the world. And I think that's Australia's future. You're not going to see many, if any, greenfield LNG projects being constructed in Australia going forward. I think we've been through that journey. At least I'm not aware of any that are coming up pretty quickly, other than greenfield upstream projects. But I think we can compete very well through our brownfield projects. And certainly the Barossa project that we're progressing to FID shortly out of Darwin is very competitively priced from a cost of supply perspective. So I'm optimistic about Australia retaining its role as a major supplier, particularly into the Asian region, going forward.
And Peter, I was wondering, because you're on the other side or well, Uniper is on the other side of this, whether these ideas that you've mentioned and that they've mentioned in terms of flexibility of portfolio, how does that feed into reaching these markets in terms of business models and a way of reaching these markets?
I mean, Tarek has mentioned cost. Kevin has mentioned, infrastructure there, reliability. But once again, it comes down to flexibility. And this is really what the market needs is flexibility, and that flexibility priced cheaply.
So when you say flexibility, is that volumes? Is that pricing flexibility? What?
Probably, I come from the perspective of volumes. Whether it's seasonal, whether it's ramping up, as I said before, that really to me is key. That's what's needed to get this market to the next level, I think.
So in order to have enough volumes for, let's say, the Atlantic and Pacific basins, being able to offer to as many clients as possible, maybe. Right.
But I would say as the market commoditizes, that's going to come in, right? I mean, as you have the ability to call on a cargo from anywhere in the world within a few days, you're going to have that flexibility. There's going to be a market that needs it. Look, I mean, we've just come from a pretty low price environment, but every drop of LNG that got produced found a home at some point. Maybe it got into storage, and maybe storage in Europe particularly is getting close to tank tops, but it's going to come, and people are optimizing their portfolios more and more, right? And I mean, that's the natural progression of this market. So I think you'll get your flexibility.
Yeah. I mean, I think I'm not sure this is the flexibility I'm talking about, really. What we've seen happen in Europe and globally this past season has been it's been a lot of supply coming in, right? And yes, we've seen a lot of physical swaps, which is great. But the flexibility really that I'm talking about is, in other markets, in other commodity markets, we do have the ability to, have physical call options that are priced efficiently, time swaps, right? These types of instruments, physically settled, and that to me is what spurs the demand for the next, for the next level.